Welcome to FinSight Updates. Let's discuss the natural hedge in case of hedging of foreign currency exposure FCE. Natural hedge has not been defined in INDAS 109, but there are discussion as per para 6.6.3 B 6.6.6. As per ICAI guidance note, the natural hedge can be read as follows: additional disclosures of any foreign currency exposure in an asset not hedged by an entity on the ground that same is covered by a corresponding foreign currency exposure in a liability and vice versa to the to the extent having same maturity date, and the amount known as natural hedge may be made in the notes. But RBI notification, which is notification number DOR.MRG.REC.76 slash 00 dash 00 dash 007 slash 2022 23, dated October 11, 2022, titled RBI Unhedged Foreign Currency Exposure Directions 2022. The natural hedge shall mean a hedge arising out of the operations of the company when cash flows offset in the risk arising out of the foreign currency exposure FCE. An exposure shall be considered as naturally hedged only if the offsetting exposure has the maturity or cash flow within same accounting year. For instance, export revenue booked as receivable may offset the exchange risk arising out of repayment obligations of an external commercial borrowing if both the exposure have same cash flow or maturity within the same accounting year. As notification 4B of the notification, banks shall assess the unhedged foreign currency exposure UFCE of entities with FCE by obtaining information on UFCE from the concerned entity borrower, provided that the information on UFC shall be obtained from entity on a quarterly basis based on statutory audit, internal audit, or self-declaration by the concerned entity. Provided further that UFC information shall be audited and certified by statutory auditors of the entity at least on an annual basis. Provisioning and capital requirements. Banks shall determine the potential loss to an entity from UFC using largest annual volatility in USD INR exchange rate during the last 10 years. The unhedged foreign currency exposure EFCE in currency other than USD shall be converted into USD using the current market rates for determining the potential loss from UFC. Banks shall determine susceptibility of the entity to adverse exchange rate movements by computing the ratio of potential loss to entity from UFC and entity's EBID over the last 4 quarters as per the latest quarterly results certified by the statutory auditors. Note 1. In case where banks are not in a position to obtain information on UFC or EBID from listed entities for the latest quarter due to restriction on disclosure of such information prior to finalization of accounts, banks shall have the option to use data pertaining to immediately preceding last 4 quarters for computing capital and provisionary requirement. Earnings before interest and depreciation shall have same meaning as defined for computation of debt service coverage ratio DSCR, that EBIT is equal profit after tax plus depreciation plus interest on debt plus lease rentals if any. Banks shall use the data published by FEDAI on largest annual volatility of USD INR rate over a period of last 10 years, and the same shall be used for computation of potential loss by multiplying it with UFC. Accordingly, banks shall apply incremental provision and provisioning requirement to all exposure to such entities as under: potential lot for EBITDA percentage, incremental provisioning requirement, and incremental capital requirements. Up to 10% of potential loss for EBITDA, incremental provisioning is 0, incremental capital requirement is 0. More than 15% and up to 30%, 20 bps 0. More than 30% and up to 50%, incremental provisioning requirement 40 bps and incremental capital requirement 0. More than 50% and up to 75%, incremental provisioning requirement 60 basis point and incremental capital requirement 0. More than 75% is incremental provisioning requirement 80 bps, 25% point increase in risk weight. Banks shall make provision as applicable to standard asset, substandard asset and NPS based on RBI norms along with the additional provisioning as mentioned above table. Similarly, bank also set extra capital to maintain capital adequacy ratio with RBI. Standard CAR ratio is 9%. Let us understand with an example the implication if there is UHFCE. Let's say a bank lends 100 crore to a company. Standard provision requirement 0.4%, that coming around 40 lakhs. Due to UFC, RBI mandates incremental provisioning of 60 basis points BPS, that is 60 lakhs. So total provisioning will be 40 lakhs plus 60 lakhs is equal to 1 crore. In similar way, the scenario we will understand in case of additional capital requirement. Take an example, a bank lends 100 crore to XYZ Limited, an Indian company. XYZ Limited has USD payable but earns revenue in INR and does not hedge its foreign currency exposure. The bank assesses that a 10% depreciation in INR could reduce XYZ's EBITDA by 60%. According to RBI UFCE guidelines, this triggers a 60 basis point additional capital requirement. 60 basis point is equal to 0.6%. Exposure is equal to 100 crore. Additional capital required is equal to 100 crore into 0.6% is equal to 60 lakh. Why it matters to borrower? Because this can affect the borrower's cost of capital as bank may pass on the cash as he kept for additional capital and provision made in books of accounts. Thank you.